Hey everybody, hey traders, welcome back. This is Chris Pulver here with a Trading 101. This is actually going to be an installment for my Options 101. It's just part of my Trading 101 video series, and I'm going to do installment number 3, and I'm going to call this one Part 3. Let me get this a little bit larger. Just bear with me. This will be Part 3, and Part 3, I'm going to talk about covered calls and also credit spread repairs. And I'll explain what that is in this video. All right, so let's dive in. I'm just going to move this out of the way. This is the list I've been preparing for you. So in video 1, if you haven't had a chance to check it out, video 1 for this Options 101 was a long call and long put. Video 2 was simple credit spreads, a bull put and bear call spread. And in this one, because you now know what a credit spread is, how do I do a credit spread repair? And also, if I own shares, how can I utilize a covered call strategy? Okay, so I'll talk about that in this video here. Credit spread repair. This is kind of the extra, pro and con of using a credit spread. What's nice is, think about it this way. Ultimately, in the stock market, we buy fractional shares of companies, right? In an options contract, one contract represents 100 shares of stock in a company. So let's use Apple again. Let's keep the example really simple. Two things. One is if I believe the price of Apple is going to go up, and 2 is I want to own more shares of Apple, then a credit spread repair strategy is a good way to think about this. Now, you need capital to own the shares. So this is important. If Apple is trading at $150 per share and I take a one contract bull put spread, right? So like we did in the video 2, I did a sell to open 150 put and a buy to open 149 put, and I collected 50 cents credit on that. Here's how a repair strategy would work, okay? Let's say that Apple earnings were awful, okay? And Apple share price, use a capital L, Apple share price dumped from 150 a share to let's say 135 per share. Okay, here's how this trade will work. Now, number 1, do I want to own Apple shares? If the answer is yes, then the credit spread repair strategy is great. Okay, now it takes some buying power, and this would be true in a lot of trades that I take in my trading room. If we're going to own stock, we're not owning typically stocks that are $150, $200, $300 indexes. We're owning shares that are, $8, $9, $10, $20, $25, $30. I like to say a lot of my allocations for 100 shares are anywhere between, $1,000 to maybe $4,000 or $5,000. So that puts me in like the $10 stock to $50 stock range. And I'm comfortable doing that because 100 shares I can repair. Again, if I believe the stock price is going to go up. Maybe that's short term, maybe that's medium term, maybe that's long term. But this will be a helpful video to show you, if you're going to keep the shares, how to calculate a break even and possibly even incorporate a covered call to get yourself out and repair the trade. All right, so all the stuff in this video. So let's say that we take a 150 by 149 bull put spread, and earnings comes out and they're awful, and it misses on earnings per share, and it misses on revenue, and Apple gaps like crazy, and it opens up at 140 and then dumps for the day another $5. And as you're approaching expiration, as expiration approaches, and let's say Apple is trading at $135 per share, this is how you can figure out, number 1, if you want to repair it, how can you do it? If you want to own it, what's your break even? And then what would I do from that point forward? Okay, so I have the 150 by 149, and I collected for 50 cents credit, right? I collected 50 cents. Now, the 150 is a sell put, and the 149 is a buy put. Now, remember, in video 1, a long put strategy, if I buy the 149 put, guess what 149 is? 149 is in a ton of profit, because a 149 put and price is trading at 135. That is a $14 move of the underlying asset in favor of that long put. Okay, so here's how it works. If I want to own Apple shares, I can do the following. I can close the 149 long put, and we'll say that we can close this for roughly $14 credit or better. Because if you do the math on that, my put strike is 149, the actual share price is 135. That move, that intrinsic value of that option contract is $14. Okay? So let's say that I can close it out for $14. Now, the way I calculate a break even is I'm going to take, by expiration, the broker is going to assign me, okay? By expiration, I will be assigned 100 shares of Apple. That's if I'm trading one contract, obviously. I'll be assigned 100 shares of Apple at $150 per share because that is my sell put level, right? So assigned at $150, okay? Credit spread at 50 cents. Long put profit at $14. What's my actual break even? When it's all said and done, I can actually take ownership of Apple, and instead of taking the shares at $150 because I have this spread opportunity, I get assigned at $150. I collected 50 cents on the credit spread, which brings my break-even price to $149.50. On top of that, I closed out the long put for $14 profit, which brings my cost basis down. So $150 minus 50 cents minus $14. I actually own the shares of Apple after the weekend, after the assignment, after the long put, after the credit. I actually own the shares at $135.50. So my break even's 135.50. Pretty nice, huh? Now remember, the actual share price, let's say we're trading at 135. It doesn't mean that I'm immediately profitable, but it does mean that I rode that stock down almost dollar for dollar, tick for tick with the dump. Okay? Now, there's obviously no guarantee that at 135.50 break even that immediately a week later the price is going to go back up and fill the gap and be at 150. But again, if I believe that the stock price will go up, I can sit on the shares if I have the buying power. How much is this going to cost me? Okay, 100 shares with a break-even price of 135.50 is going to be what? Take this break-even price times 100 shares. I need to have at least $13,550 cash margin. Okay, so that's going to be my total requirement. So $13,550. And this is why I don't do this very often with expensive stocks. I don't do this very often with indexes. I just trade a lot of options because, if I've got even a $30,000, $40,000, $50,000 account, even a $100,000 account, I don't really want to allocate 13% of my portfolio to Apple. Although I think there would be some safety there. I can also just buy a put and protect my ownership. I can protect the downside. But that's not what we're talking about today. This is just how do I calculate my break even. So what can I do with all this? Well, if I own the shares at 135.50, that's my break even. Once I come back to trading the next week, if I come back to trading the next week and I know my break even is 135.50, I can then incorporate a covered call. Because I own shares of Apple, I could then do the following. The next week, I can sell a 136 call. And it would be this. I can sell, maybe a 136 sell to open call, and that would be one contract, so that covers the 100 shares. And let's say the broker offers me, 40 cents credit. If I sell a covered call, and that's just a call contract against the shares that I own, and I'm offered 40 cents for that. Well, that means that my 135.50 break even, and now I have a covered call credit. That brings my break even down to what? 135.10. And if I get the stock called away, now let's say Apple rallies to 140, which exceeds the 136 sell call level, right? If I sold the 136, my net profit, stock gets called away at 136, and I keep $90 cents per contract profit, right? 90 cents net profit times the 100 shares that I'm in equals a $90 profit on Apple. Now that might not seem like a lot, but I could have lost 50 cents initially, so I can either lose 50 cents and just, not take any shares, or I can repair that trade. So the risk was 50 cents. If I believe that, number one, it's nice to own the stock. I think the stock inherently will go higher. Maybe it fills a gap. Maybe we're in a bull market. Maybe it's just a dip or a pullback that I didn't anticipate the big move. I can take a $50 loss and turn it into a $90 win. That simple. Okay. And obviously I'm not just trying to turn around immediately and try to cover it. If I think that Apple can go back, ideally, we let Apple do its thing. And if price rallies to fill the 150 gap, I know my break even's 135.50. So I can simply sell my shares at the gap fill. And so if price hits 150, my ownership is 135.50 initially, right? Once I took the assignment and stuff, I would make $14.50 per share. I'm in 100 shares. Now my profit is a lot bigger, right? For 100 shares at $14.50 share, I make a good chunk of profit. That's a lot better than making $90. But obviously price has to move. Price has to go from 135 back up to fill the gap at 150. I make a lot of money. But remember, if I'm making $1,450, that's great, and everyone's going to be like, "Oh, that's great. I'd rather make that than $90." But remember, it's going to take $13,550 of cash or margin in order to generate that profit. So realistically, 1450 divided by 13,550, okay, I'm only making about 10.7% on that return, which still great return to flip it in a couple weeks or whatever. But I had to pour out a lot of capital. I had to tie up a lot of margin, a lot of cash in order to flip that stock. And obviously I need price to go my way as well. So all this means is it's easy to repair a credit spread if you have the buying power, have the cash to take on the shares. And do I do this with stocks that are $100 to $200? Rarely. Do I do this with stocks that are, $20 to $40 to $50? Yes. Do I want those stocks to be in an overall good position and buying at lows and owning at lows? Yes. Do I want to see the market overall in a better bullish market? Ideally, yes. Okay. So if you're thinking about repairing a credit spread, think about the overall market. If the overall market is down, okay, you might have the right intentions to repair, but if you own the stock here and it keeps dropping and you still own it here, that doesn't help. That just means the price is moving further and further away from your break even. So if you're in a bear market, but you're like, I'm still going to keep the shares, then buy a put and put out a put for maybe 30 to 45 days and protect your downside if you have to, if you want to own the stock. But on an example like this, I mean, this is an expensive allocation to repair a credit spread. So the reality is, for me, I don't necessarily want to tie up $13,000 of cash or margin. I'm okay just dumping the trade for 50 cents and then reestablishing a new position. Case in point would be this. Instead of taking all this to repair my trade for $90, what I can do is this could be a one contract trade, and then the next week I can do a 135 by 134, and I'll just take more of an at the money approach and I'll do a two contract trade. That makes sense? So this costs me $50 in risk. I can do a two contract trade. I'm going to risk at max $100. But if I win on this credit spread, if I did a 135 and that was a sell put and I did a 134 and price is up above that, if I did that for two contracts, I make $100, right? If I make $100 and keep $100, I can lose 50 cents here. I can keep $100 here. My net profit's still 50 cents. And I didn't have to allocate $13,000 of cash or margin. I just traded credit spreads only. Does that make sense? So that's the combination of, if you want to repair it, you're going to have some cash margin to take the ownership, and then a covered call strategy to know your break even, and just basically cover it above your break even and get out of the trade and turn a losing trade into a win. That's the repair. Okay. Overall, covered calls are great. What I typically do is I don't like to just throw in covered calls just to throw them in. What I do is I throw in covered calls at levels that I want to get the stock called away. So if Apple's trading at 150 and now all of a sudden it's up to 160, if I want to lose the stock and say, you know what, I'm comfortable taking $10 a share, then I'll sell a 160 call. If price goes above that, I get a little bit of premium to get it called away. I still take my $10 a share. I'm happy. Does that make sense? So covered calls can be good and bad. I see a lot of strategies where it's like this rolled covered call and you just keep rolling and rolling and rolling, and that's great in a bull market. But if it's a sideways market, if it's a down market, it just depends. There's always trade-offs with these option strategies. Okay, so I hope this video makes sense. This is installment 3 from Options Trading 101. Again, credit spread repair. Hopefully you can calculate a break even. Again, you see me do this all the time in my trading room. So if you're interested, I have in my Discord channel, I've got all my education links for joining my Equities on Man trading room, and then covered calls as well if it's fitting, if it makes sense. But do not sell a naked call. A covered call is you sell a call against the shares you own. So if I have 500 shares of something, I can sell 5 contracts to cover the entire amount. And if the stock gets called away, the broker pays me a premium to get it called away. If the stock goes through that level, it doesn't matter. I max out my profit here, but I at least get paid to do it. Okay. If the price is at the money, if the price is in the money, you can collect a little bit more premium that way. But covered calls are great. And like I said, if you're willing to part ways with the stock, if you're looking at flipping it for a couple of bucks a share, uh, or just hang on to it forever, doesn't matter, then there's no such thing as a covered call strategy other than generating income. You never want the stock to get called away. Example, if I owned Apple and I'm like, you know what, Apple's 150 bucks a share, I'm not going to get it called away until it's $1,000 a share. Then never, ever, ever get your Apple shares called away. Roll the covered call, roll the covered call, roll the covered call, roll the covered call. Never let it get called away. And you can do that as long as the price goes higher. And I can talk about that more in a video, or just again leave a comment, ask me questions. Right? Again, for the sake of time, I'll let you go in this video, and I'll do one more installment with a bonus video, and that's going to be video 4 for my options 101. And this is going to be a little bit fancier. The names are really silly, but I'll tell you what these are. This is a long strangle and a long straddle. We do this quite a bit in my Equities on Demand as well as my Delta Trader courses. All right. Again, thanks for watching. Like and subscribe, all that good stuff. Leave a thumbs up for me to support the channel in this video, and I'll see you in the next one. Thanks. Bye.